Moving on now to Bajaj Auto, that's under pressure despite reporting a strong set of Q4 earnings. The company's margins have expanded by 80 basis points to 20.1%. Revenue performance looks good, above street expectation, and profits have seen a more than 30% jump. Rakesh Sharma, ED of Bajaj Auto, is with us on the show now. Mr. Sharma, morning, and thank you very much for joining in. In the call yesterday, you have said that the industry growth will be 7 to 8% in FY25, and the company will do better given your rising share of 125cc plus. Now the question is, can your volume growth be in double digit? Last year you did 10.4%. Can you do better than last year, in FY25?
Good morning. Well, that certainly is the aspiration. And if you just take the recent past of, let's say, Q4, we have grown twice the rate of the industry growth. And in the 125cc plus, the upper half of the industry, we have grown 4 times that of the industry size. Now, this has been driven by largely, the slew of new launches, which have been very well received in the Pulsar brand. So we have already got traction, and we have confidence that this should continue. So if the industry returns something like a 7 to 8% growth, I'm expecting that the structure of the growth will be similar, which is the top half will grow faster than the bottom half, and we will grow faster than the industry in both the top half and the bottom half.
Do you want to put a number to that? Faster, could it be 2x? If 7 to 8% is the industry, can you repeat the performance of Q4 and grow 15%?
I would not be able to give you a precise number, but I have told you a very good indicator of future performance is the recent past. And if the industry grows at 7 to 8%, I have no reason to believe, given the track record, that why we should not be in double digits. We would certainly be driving for a double-digit growth.
Okay, all right. Hi, Mr. Sharma. Good morning and good to see you. When you're sounding pretty optimistic in terms of growth, and your margins as well clocked more than 20% for the second quarter running. But before we get to the margins, I want to ask you about exports. The last few years, last 2 years at least, you've seen a bit of a degrowth out there, and that's that's what the industry has been under pressure. I think it's still 25% off the peak that we saw in FY22. Now, the bullish sentiment on the street is that you'll at least see, 11 to a 15% growth in exports for this year. Do you believe that that's possible for the coming year? That's FY25 as well as FY26. That's the rough per annum growth that the street is factoring in.
So, the way to look at exports now is that we have to start to segment the market, overseas markets. Now, we cannot paint the entire world with the same brush, because what we have done for our financial year 25 planning is to segregate the markets in 3 buckets. The first are the stressed markets. Unfortunately, some of our large markets like Nigeria and Bangladesh are in that. We've taken a very, very sanguine view about what to expect in these markets. We will roll with how things go in those markets. Then there are the most of the other markets. They are showing a very good recovery, particularly in Latin America and now ASEAN, Philippines, etc. Here we have assumed a very aggressive stance, again on the basis of our recent success, particularly in Latin America. For example, our growth in Latin America has been, in Pulse, has been 26%. And that has affected both the bottom line and the top line, as you can imagine. And then there is the third bucket, which is some of the new markets, which will start to kick in, but not in a very significant way. These are places like, Brazil, where our new plant comes on stream in May, which will help us unlock pent-up demand and expand the network footprint. These are places like Venezuela. We are making an entry into Europe, which hopefully by the second half, or let's say at least the last quarter of the financial year, will start to show some impact. So therefore, when we, despite taking a conservative view of these troubled markets, we feel that FY25 will be certainly better than FY24. But having said all that, you must also keep in mind that there is a base effect also, which will start to show up in the growth numbers.
Mr. Sharma, is there a you've alluded to in the past some of the macro variables, right? Dollar, for example, dollar shortage in many African markets. Dollar is on the rise, Mr. Sharma, in a meaningful way, and it perhaps the forecasts are. I mean, we're not experts, but forecasts are that there is upside risk here. Does that become a bit of a headwind, especially in some of these African markets for you? And impede any recovery that you may be seeing there if that trend continues? Or do you think the worst is behind?
Well, after the passage of last year, I'm very, very loath to say that the worst is behind us, because the situation on the currency end is quite fragile still. And that is the reason why I said we've taken a sanguine view of some of these markets in our planning, and we will just roll along. And you are right, it is, the single most important challenge which we are facing. And it's not just the availability of the currency, which I must say is improving, but it is also the inflation caused by the devaluation. So the purchasing power to begin with in these economies is not very high, and the consumer takes time to digest the price increases which are due to the devaluation. So that factor is also over there.
Mr. Sharma, what's the planning on margins for FY25? In Q4, the commodity basket was fairly neutral for you, but in Q1, we've started seeing a rise, particularly in copper prices. Aluminum prices too have inched up. So is there a risk?
Well, I won't say there is a risk. We also noticed this slight uptick, and we have actually been very proactive, and we have taken a little bit of a price increase on 1st of April, just so that, we are at pace with these expected cost increases. But having said that, a lot of these cost increases are also getting neutralized by some reductions, gentle reductions, which we are seeing in, noble metals, etc. And then, of course, there is the gentle devaluation of the dollar, which particularly in the last 6 to 8 weeks, we have noticed the realizations are improving. So that is very, very helpful. So when you combine all this, then at least as we stand, we are not really so concerned about the margin outlook. And I must just remind you, and I must just sort of point this out, that though our two-wheeler EV business has, gained substantially, I mean, it's gone from, we are now clocking 15,000 units per month, which, as you all know, that the margins are lower than the corporate margins. But thanks to some of the cost saving work and R&D work, as well as sourcing work, supply chain work, we've been able to mitigate the impact on margins of the substantive rise in the electric two-wheeler business.
Just a quick word, how much lower are the EV margins versus ICE margins for you?
See, we don't get into segmental level margins, but obviously they are lower than the corporate margins.
On a unit level, it's loss-making?
Well, like I said, we don't get into the unit level descriptions and all that. But of course, these are much lower than the corporate margins which we have. And Bajaj Auto margins are a blended margin between international, domestic, three-wheelers, premium bikes, entry-level bikes, etc.
We'll let you go at that then, Mr. Sharma, but we're looking forward to having a chat with you maybe by the end of the month when we get your monthly numbers as well. Wishing you a good day ahead.